Everybody, happy Monday. Hope you're doing well. Thanks very much for being here. I want to say thanks also for leaving all the comments and sending in the suggestions. It's really good because then I know at least what I'm speaking about on camera here, it resonates with you, or at least is thematic for a good chunk of you. So I appreciate that. Saves everybody time. Um, One of the questions came in around goal setting and being a trend follower. I think I don't have the question in front of me, but I'll get to the meat and potatoes of it. Was like I can't just sit and set a goal and say I want to make 40% a year and then have it just show up. So I would debate you on that. I think you can manifest exactly, what it is that you want in life, but then you have to act intentionally. If you for example don't know what the expected value of your trading rules are, there might be a bit of a disconnect. But I would still argue that you're better off having 40% as a dream or as a goal, right? Because then over time you get to conjugate your behavior with the results that you're getting. Of course, if you backtest the system, you'll have the data to know, like, has it happened before? Of course, you can say, well, just because it hasn't happened doesn't mean it's not going to happen, but you typically need to know what type of risk unit you need, right? On a risk unit means what's your R? What is your per trade risk of your overall capital, right? And then you have to figure out the number of winners and losers. So then you can use Kelly criterion and also try to figure out what are the sheer number of trades that you would have to put on with your winning and losing percent and your expected value in order to put yourself in the neighborhood where you could earn 40%. A lot of folks have dreams of making big money, but their bet sizes are too small. So they would have to put on 10,000 trades in a year in order to get where they want to go. So it's not terribly practical. And there's no real fault there. It's just that they're ignorant as to what the rules are. Also, if you're very short-sighted or myopic in your trading, where you're constantly taking smaller winners or cauterizing everyone at, say, plus 3R, good for you. No one's gonna. I'm not gonna hit you over the head for making money, but when you lock yourself into those types of rates of return, mathematically you put higher rates of return out of possibility. So you really need to think first, where is it that you want to go? What do you want your trading to do for you? Is it to give you a lot of busy work during the day? Or are you at the stage of your career where you're just excited to be in the business in the first place? Nothing wrong with it. But ultimately, you kind of have to have a vision for where you want to go. So to answer the question that came in the YouTube channel, the goal necessarily wouldn't be to say, I want to make 40% a year and manifest it. A better way at the beginning might be to say, I want to make 40% a year, and my goal is to find the process that I can follow, that I'm compatible with, that I could trade day after day, which might mean certain days there aren't any trades and I'm still following my system, so that ultimately I put myself in the neighborhood of having 40% a year pre-tax, net rate of return. And then the goal would be to follow that, right? So you could say, my goal is to follow a set of rules with which I'm compatible that puts me in the neighborhood of 40-50% net trading gains on the year, and do that every day. And then pray for the discipline or develop the discipline that can get you there. As opposed to just saying, I want to pick a random number out of a hat. That typically doesn't work. And if it does work, it takes a long time because it's only through constant iteration and lots of experimentation, which I think a lot of folks have trouble with because they're afraid to lose money. Now, on that, I'm not necessarily afraid to lose money because you can't, as the lottery says, you can't win it if you're not in it. And trading is very much the same, except you're the casino. You know that period over period. The traders who trade against you might win more frequently, but you're going to make more money by following your rules, having positive expected value. Again, I've gone on and on about simulators and how they can help you and what it is that you can learn from them. about your trading. Of course, if you could marry your behavior with the actual rules that you were backtesting. I always was excited about it because I came from being more of a data scientist, an at-home data scientist, not professionally. But I just got into the habit as a young kid of looking at data and putting it into spreadsheets and then manipulating that data to see all kinds of discoveries. So then as I learned more and more math, it opens your brain and the data can tell you a different story than what's on the chart. And so that's a really great spot to be. I always encourage folks to do that because you can learn a lot about yourself. And self-knowledge to me is more important than reading charts. But, learning charts easy. You call up any website. You don't even have to pay for it anymore. You could just start adding overlays and changing time frames. And so that's kind of a lazy person's way of doing it as far as I'm concerned. If I, teach class on this stuff, it's not to hold a person's feet to the fire because that doesn't serve a purpose. But there comes a point where you have to be accountable. And one of the bigger issues for traders is that if they're only accountable to themselves, they can run into issues because no one is there as the voice of reason to say, do you really want to do this? Or what do you think you're getting out of this? You think you're seeking trading gains, but what you get out of the trade might be something very, very different. Or your subconscious could be running the show and you might be doing it for some very deep-seated emotional and psychological reasons. But I think that's how I would approach the concept of picking out a certain rate of return. 40%, which is what was mentioned in the comment in YouTube, it's a number. Maybe it's good, maybe it's bad. It's very subjective. You have to figure out what's best for you. I always just try to think about like a good default for those of you who are just starting is to think like, here's your starting capital. And then think of like what we call the rule of 72. Whatever rate of return you're seeking, divide that into 72, and that should give you, again, a pre-tax number of years that it would take you to double your money. So if you're looking at, 24%, 2% a month, basically take you 3 years to double your money. Now, if you could do that consistently, you can see how your money could compound, again, before taxes, depending on the type of account you're in. But that would at least put you in the neighborhood of how to pick that number and have more relevance or have more meaning for you based on the time that you have and what you're willing to do in order to develop your craft. I don't feel, I can't put a comment on 40% because it's personal. It might be good. It might be too understated for what the person's risk tolerance is. But in a long-winded way, I would just say that the goal wouldn't be to state that number. It would be to state intentionally that your goal is to have a set of rules that you can follow day after day, that if you did that over time, right, because it's not based on a calendar year, you're going to have drawdowns of a certain magnitude for a certain amount of time. You can kind of demystify the whole process and say, hey, could I live with this if this was what I was willing to put together? So I think backtesting is very valuable because you really don't think of what the drawdown's going to do to you. Now, generally speaking, if you're looking for 40% rate of return, you would have to think that 20% drawdown is reasonable, right? In fact, some buy and hold managers, even some larger CTAs, are almost 1-to-1, which means they may have 40%, but they may regularly have 40% drawdowns with a 40% compounded annual growth rate. To me, if you were going to look to do this, and especially if you wanted to run client money, or what I always say is outside money, the closer you can get to like 2-to-1 in terms of compounded annual growth rate is the 2, and then the 1 would be, say, 20% of a drawdown. The lower you can go on the drawdown and make the rate of return of the compounded annual growth rate several multiples of what your drawdown is, especially when the drawdown is low, then you're really onto something, because you'll attract a lot of money in that regard. And that's one of the benefits of doing the back test, is to see not just what can you get, but what are you going to have to live through as far as drawdown's concerned. Because that's a huge part of kind of becoming compatible with the system, is how do you handle losses? And if all you're looking for is the upside and what that's going to do for your life, that's great. But you have to also take the thick with the thin. And so when you're in drawdown, how do you behave? Because the drawdowns, they might last several months, in which case you still have to act the same as if you were up 30%. So I can get more into that if you'd want to, but I'd have to see it in the comments and see which direction to take this, because, I've been back testing my whole life just to experiment, just to kind of see and get my brain going, because it's evidence-based, right? You get the data, then you kind of go through the rules and say, okay, where's my blind spot here? What am I not considering? I always use 10, 20 years, too, because you have to look through the times when the markets were more challenging. So if you were thinking about making 40% a year ongoing, how did your rules do in 07, 08 when we were in the middle of the subprime morass, right? How did things go for you during 9/11? Those types of stress tests. So anyway, good question. I think I've answered it very thoroughly. I appreciate you all being here. Please like and subscribe, and I'll see you tomorrow. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.